Hello, Madam President. I'm here to give you a quick overview of our country, Macronesia's current economic conditions. Here's the agenda for what we will be talking about today. Let's start off with Macronesia's economic conditions summary. Our GDP is growing at 2.7%, which shows modest economic expansion. However, our unemployment rate is 5.5% and inflation remains at 3.5%, a bit above the target. The interest rate is at 3.0%, following recent hikes by the central bank aimed at controlling inflation. Consumer confidence is declining slightly, suggesting that households may be becoming more cautious with spending. Taken together, these indicators show that the economy is slowing. We're still growing, but at a weaker pace. Based on this, I would say we are in the late expansion or early contraction phase of the business cycle. Now let's take a look at some visual models to understand what's really going on. First, the ADAS graph. On the aggregate demand aggregate supply graph, we can see that aggregate demand has started to shift leftward, largely due to high interest rates and decreasing consumer confidence. This puts us slightly below full employment output, signaling a potential contraction if conditions continue. Second, the Phillips curve. Now looking at the Phillips curve, we see the classic trade-off between inflation and unemployment. Currently, with moderate inflation around 3.5% and rising unemployment 5.5%, we're likely moving up the short-run Phillips curve, meaning inflation is decreasing slightly, but unemployment is starting to rise as businesses slow hiring. Third, the loanable funds market. In the loanable funds market, we notice a decline in the demand for investment funds due to rising interest rates. As borrowing becomes more expensive, businesses invest less. This helps fight inflation but can also slow economic growth and contribute to unemployment, as we're starting to see. Now let's look at the policy recommendation for Macronesia. Given the situation, I recommend pursuing a moderate expansionary fiscal policy to support demand without overstimulating inflation. This could include targeted government spending, especially in areas like infrastructure or job training programs, to stimulate employment and maintain GDP growth, while allowing the central bank to keep interest rates stable. Referring back to our ADAS graph, this policy would help shift aggregate demand rightward, bringing us back closer to full employment without overly increasing inflation. Of course, there are trade-offs. Expansionary fiscal policy might pressure inflation upward again, and it could raise the national debt. But with inflation relatively under control and hiring beginning to slow, it's more important to support economic activity and prevent a deeper downturn. Now for the reflection and wrap-up. The most challenging part of this analysis was balancing the risks of inflation with the need to support employment. It's not always a clear-cut which policy is best, especially when indicators send mixed signals. But through this process, I've gained a much better understanding of how macroeconomic models and real-world data work together to guide economic decisions. Thank you for your time, Madam President.